Welcome to the Leaders in Housing Counseling call. Looks like we have a very strong turnout today, and thank you very much. Glad to see it. Um, we are going to have, I think, a valuable conversation about an issue that's dear to everybody's heart around um, student loans, and we hope something will be very useful for people. Here's what the plan is for the call today. We're going to do NHRC legislative updates. I'm going to step in. Melody's out on a medical today, and so I'll do my best to hold up the fort on that. Ellie's going to give sort of a quick update on certification and where things are at. Hopeful, I think, some good news. We'll spend almost the entire call on this public service loan. Well, I want to be more specific. This is really about student loan issues in general, and of which public service loan forgiveness is one piece of it. But this is a program that's really designed to deal with the range of issues that people have with student loans. And we think, a very useful tool, and we have come to an agreement so that under the NHRC umbrella, we will be able to get a discount for it's free for a number of services for using the basic tool, and then if you want to use them for actually making applications, there's a charge schedule, and we've been able to get a discount for all HUD-approved housing counseling agencies, and an even deeper discount if you're a member of NHRC. So that we think this is very valuable, and we'll spend some serious time on how it works, and hopefully it'll meet the needs that you've got for your clients and for your staff. We'll do a quick plug in on a picture still worth 1,000 words. These pictures are great. We love them coming in, so please do that. We'll mention NHRC membership, and then a quick reminder about our next call coming up in March, which will be aimed at more legislative issues and some of the advocacy we're doing in Congress. And I also want to just mention, I know that we've got some people who aren't regularly on our calls. We did cast the net wider for this call because we thought it had broad appeal. And if you are interested in being regularly on these calls, plus getting our informational emails, just go to our website, www.hsgcenter.org, and click on the mailing list up in the upper right hand, and get signed up in there, and we'll be glad to include you on the list going forward. So with that quick note, let's just go into where we're at on the legislative work. Melody had lined up, and we had a number of highly effective meetings in the House and Senate over the last 2 weeks, some on the phone and some in person. We've started to do lobby days. The President's budget just came out, and we were unfortunately listed at $45 million again, so that's the lowest rung, and frustrating to see it happen again. And we're not surprised. We did expect that, but it means that much more work to get us up to a more satisfactory, more appropriate funding level. Every indication we've had in conversations in the House, especially with Representative Price out of North Carolina, who's the head of the Appropriations THUD subcommittee, is that they will go for a strong number. We expect it'll be in the 60 million range again, and we should do all we can to get support for that number among House of Representative members. Our real job is going to be again in the Senate, just like it is every year. Very exasperating. There have been a number of key Republican senators who have been supportive around a higher number for housing counseling. We really struggled this past year, and they first put us in at 45, did bump it up, and then in the end at 50, and then finally the number in the negotiations ended up at 53. So it was better than it could have been, but we really hope to get closer to 60 next time around. And the only way to do that is through the kind of outreach efforts that groups do, and hearing from constituents from in the House and Senate. So right now is the time where they make appropriation requests to the THUD Appropriation Subcommittee. And what that means is that they will submit a letter Not everybody does it, but many of them do, and they'll send a letter saying what their priorities are. So if we can have 65 million for HUD housing counseling assistance on their letter, that's the most valuable. Everybody in the Senate, you all have senators out there. If you could take the time to reach out to both of your senators and send them a request in writing, some of them will have forms and Melody can help you fill out the form. Some of them just take the reference, some of them just take a call. But the ideal thing would be to shoot them an email now and ask for the HUD approved housing counseling funding to be at $65 million in their THUD appropriations request. And that will be valuable. And you can add a line about why it's important, but it's really the constituent requests that get this moving. We'll put in the request in the form of the sign-on letter that thank you. We've got, well, I don't actually know how many people have signed it already, but quite a few organizations have signed it, and we'll circulate that. A few offices will use that as their basis, but that's unusual, and the personal contact will make the big difference. We're also doing a lot of work on other legislation that will help housing counseling, and the availability of affordable housing out there are two touchstones. And so we've talked a lot about disaster recovery and this reform bill for CDBG disaster recovery legislation. It appears that there's a compromise with Senator Tillis and Senator Schatz and Young about what the final bill will look like. Melody talked about this 2 weeks ago. We haven't actually seen the wording, but we are being told by the Low Income Housing Coalition that everything they're hearing is that this is a smaller jurisdictional issue and has doesn't really affect the things we were most concerned about. So that's very valuable. We'd like to get housing counseling specifically mentioned in that legislation. They included something that was more general, and we're trying to get them to be more specific. And so that'll be an area we pay a lot of attention to. There's been a lot of interest around credit issues, and we're trying to get some housing counseling credit issues included in that. And very interesting, there's been a surge of interest in rental issues. And a few weeks ago, we had the CHN program in Cleveland where they intervened on evictions and worked with Legal Aid and the United Way in their community to help get some funds to prevent the eviction and then also get people back on their feet again around other financial issues. We're trying to promote that as the model, and we're trying to get that model integrated into the legislation. So Senators Portman and Bennett have introduced the bill, and we understand that there's been support for that as well from others. So that may have some legs, and that's pretty exciting. And the last one that we've been pleasantly surprised about was the Housing Financial Literacy Act of 2019, which passed the House with bipartisan support. Peters out of Michigan has supported it on the Democratic side, but they really needed Republican support. Cronin from Texas has expressed interest, and they're working on the final wording. Hopefully it'll be pretty close to what passed the House, which means it's a quarter-point discount on FHA mortgage insurance premiums if you complete a program with a HUD-approved housing counseling agency. You can see we helped design some of this, and that it would also be required that the counseling happen before people sign a sales agreement or a loan application. So that what we're really trying to do is get to people in the front end when we can be the most useful. So lots of good things out there in terms of legislation. There's some infrastructure bills, and Representative Waters in the House. We've been working with her staff on a number of housing supply bills around infrastructure and things like that. All of these are valuable. So just to keep you up to date on these things, but the most valuable thing you could do right now is to reach out, especially to your senators, and ask them for the program request to the THUD Appropriations Committee, a subcommittee, and for $65 million. House and Senate are both useful, but especially useful in the Senate. Good. Okay, so we'd like to also do a quick update on certification and what we're learning. So Ellie, do you want to pick up on that?
Sure. Thanks, Bruce. Hi, everybody. Just a quick update on where we're at with the certification. So as of the end of January, 41% of the organizations in the country have a HUD certified counselor. That's 708 agencies. If you want to know how your state in particular is doing, the link on the slide here brings you to state level data. And if people are interested, I will send that out, send that link out along with the PowerPoint and the recording of this presentation when we're done, so that you can see how your state is doing. Something that got pointed out and that I think is important to make sure everybody pays attention to and realizes is that every agency must designate an FHA Connections application coordinator. That application coordinator is the person that will verify the counselor's employment at a HUD approved organization. Because as you remember, it's passing the exam and working at a HUD approved organization that makes somebody a certified housing counselor. So just passing the exam does not make you a certified counselor. So if you don't have an FHAC application coordinator designated at your organization, you need to do that. I will say we've had a couple of conversations with folks at HUD, and they're telling us that at this point, just above 1,800 counselors have passed the certification exam, and that there are just over 4,000 counselors that need to take that overall. So we're not quite at half. But the other thing important to this FHA Connections application coordinator is that there are 300 agencies that have not assigned an application coordinator. And without that person, that means that there are counselors at that organization taking the exam and not getting verified employment. And HUD estimates that there's another 200 to 300 counselors that have actually taken the exam and have not yet been verified. So that would put us over 2,000 counselors and much closer to the halfway point. So again, just a little update on that, and make sure you get that done. And if anybody has any questions about any of this stuff, please feel free to reach out to me directly, epepper@hsgcenter.org. I'm happy to chat with people, answer questions, direct you where you need to go.
And I want to just add to that, thank you for the people who filled out the survey on English as a second language and people with disabilities. The raw material from that, Ellie's put together. We did have a conversation this week with senior people at HUD about certification and some of the issues that we're hearing about. But certainly, if you've got issues, please get them to Ellie. She's becoming our sort of conduit for the critical issues that we need to get out in front of HUD to try to get this to be to get us across the finish line. Lots of work being done by lots of excellent organizations. There'll be lots more training available. The training groups are really doing an excellent job. It does show that people who take the trainings and then take the test pretty quickly afterwards, they've had a very high pass rate. First tries around 68% right now, and on the second try, it goes up to 78%. So that's, I think, 70 or 73%, whatever the number was. I'm not remembering exactly. But the good news is that we've got a pretty high success rate at getting people through. So taking the training and then taking a test very quickly afterwards while it's fresh in your mind seems to be the most valuable takeaway from what we're hearing. Okay.
So before we go away from this, somebody on the call very rightly pointed out that If you are a certified counselor and are the FHA coordinator, you cannot validate yourself. You have to set up a second person. So thank you for pointing that out. So make sure that if you are the FHA application coordinator, that somebody else is an application coordinator so you can get verified.
Okay, good. So let's move on to our topic at hand today. So we've done a lot of work around student loans and student debt. We know this is a major issue for our constituents, and we also know it's an issue for a number of our staff members. And so I'd like to have people keep in mind both teams of people here. We are talking about a tool that will be helpful, we think, to serving both populations. And the opportunity here is pretty large, and this is a mechanical tool, an app that will be, we think, helps solve people's situations. We're going to walk through it in some depth, but we hope that this will be valuable in a way that takes the burden of dealing with these issues off of the counselor and will allow clients and staff to be able to do these things. I'm also very, very interested in trying to build out our ability for people who work for us to qualify when it's appropriate for the Federal Student Loan Forgiveness Program. And as I'm sure you've heard, there's been a really high fail rate. And we're thinking that with this tool, what happens is that you can be sure to get into the right product. So one of the reasons that people didn't qualify was they weren't in the right product, and the services did not do a good job about getting them in for probably bad reasons. And then people had problems documenting their work history. And you, as the employer, as a nonprofit employer, could provide that documentation every year, and it gets filed and it gets locked in. So it makes it much easier for people to qualify for this benefit, and that's a valuable thing in terms of staff retention, of being able to keep people in our field, even though we don't have the highest salaries for the work that people do. So we think this is good for clients. We think it's good for our internal workforce as well, and so we're pretty excited about it. So on that note, let me turn it over to Ellie.
Thanks again, Bruce. So yeah, we're really excited about this. We have Lindsay Clark, who is the Director of Partnerships at Savvy, where she oversees development and management of national partnerships. So Lindsay, having accumulated quite a bit of student debt of her own over the course of her undergrad and graduate studies, has become a fierce champion for the student loan borrower. So Lindsay, take it away.
Yes, thank you so much, Ellie and Bruce. And I'm really excited to be here with you all today. And as Ellie mentioned, I do have quite a bit of student debt myself. And every one of us at Savvy comes from a background where we've done policy and advocacy work, but most of us are at heart student loan borrowers, and that sort of informs why we do what we do. So thanks. Just a quick look at what I'm going to be talking about today. I'm going to sort of introduce Savvy, talk about who we are, our background, because I think it's important to what we're trying to do and the technology that we've built that we're going to show you here today, and how we're going to be partnering with NHRC and you all, hopefully, to enable your communities to make the best of this technology and this service to help borrowers, ultimately free themselves of their student debt. Part of that is going to be just doing a basic overview of the student debt landscape. This is all going to be in the context of the Savvy platform itself. So, we're not going to be talking and going into great detail about things that aren't going to be relevant to what the tool does and what will be, important for us to understand. So these will include things like federal repayment plans, public service loan forgiveness is sort of the big one. And then I'm going to do sort of a walkthrough demo of the actual platform itself, show you how it works, And then I will leave room for questions at the end. You can go to the next slide, Ellie. So just to start off, a little bit about Savvy and who we are and what we do. We are a social impact startup based out of Washington, D.C. We are a registered public benefit company. We take that pretty seriously. We like to consider ourselves, first and foremost, almost as advocates for the borrower. The borrower comes first. We are driven by outcomes and not solutions. So we don't have a dog in this fight. We're not trying to make money off of your student loans or refinancing your student loans or anything like that. We are driven by delivering the best possible outcome for that borrower. And every borrower is different. There's no one-size-fits-all solution. And that's sort of the perspective that we've taken when creating the platform that we have. We basically designed a tool that allowed us to help borrowers as consumers. And we focus on two major components of sort of the student loan landscape here, which is forgiveness and repayment. And these go hand in hand, sort of a yin and yang. Especially, if you are eligible for forgiveness, the repayment component is equally important. But what we focus on around repayment are specifically things called income-driven repayment plans. And these are powerful repayment plan options available to federal loan borrowers that basically, and we'll talk about this a little bit, in more detail later on, base the borrower's monthly payment not on their debt amount, but on their income. And so for middle to lower income borrowers, this is extremely impactful. I mean, we see regular savings of upwards of $200 a month on student loan payments. And again, this ties into eligibility for forgiveness and so on. I will say we were founded by two guys coming from the policy and advocacy landscape. They actually helped write some of the legislation around things like public service loan forgiveness. They have been fierce advocates for borrowers for a very, very long time. And it's sort of this expertise in and around student loans that really shapes and drives everything that we do. It sets us apart from other companies in that, this expertise gives us the ability to help the borrower in ways that they normally wouldn't be able to be assisted. And I think that whereas in other situations with, for example, let's say a refinancing company, Savvy is not going to be pushing, like I said, one solution. We are going to be able to show the borrower all of their options and identify the optimal one based on that particular borrower's situation. Ellie, you can go to the next one. So this screen is intended to be overwhelming. It basically gives a look at the maze of options that a borrower faces when entering into repayment with federal loans. So if it is overwhelming, that was the intention. It basically looks at all the different types of repayment plans, forgiveness options, forbearance programs, and deferment that a borrower has at their disposal. And this is one of the main reasons why it is so difficult for borrowers to navigate on their own. They're faced with all of these decisions, unsure, which one is going to be the best for their situation. And on top of that, they have to deal with a federal servicer. And I say this to, any borrower that I meet, when you are relying on the advice of your federal servicer when it comes to making decisions around your student loans, it makes me very nervous. And I'm sure many of you might have heard of the lawsuits that are currently going on against these servicers because they have, mismanaged, advised to the disadvantage of the borrower in many situations. And so what Savvy really tries to do is cut out all the noise that the servicers might produce and help the borrower identify their best option, but ensure that they are able to achieve that outcome. And I think that there are a lot of touch points along the way as far as, any borrower in the process of repayment. And we really, there's no beginning, middle, or end to our relationship with the borrower. We see through, from start to finish, making sure that borrower is taken care of, that paperwork is successful, those applications are successful, and that borrower is continuing to see savings through the lifetime of their loan. Next screen. So just a quick overview around federal loans. And I think just going through these basics is going to help you, give you a better idea around what Savvy sort of specializes in and why these components are so important when it comes to, the student loan landscape. So one of the most important aspects around federal student loans is, as I just was talking about, federal student loan servicers. These are your Navients, your Great Lakes, your Nelnets. Every borrower is given a student loan servicer when they go into repayment. These servicers are commissioned by the Department of Education. Savvy is not a servicer. We're not going to replace the borrower's current servicer. We instead are working to sort of navigate that relationship between the borrower and the servicer. And as I mentioned before, to advocate on the borrower's behalf if necessary. But we do not replace them. The borrower continues to make payments to their servicer. Another aspect of federal loans is the fact that there are different types of federal loans. And two of the biggest loan programs in existence currently are direct loans and FFEL loans, FFEL loans, Federal Family Education Loans. Now, the reason I mention this is because FFEL loans, if you were in school prior to 2010, there's a good chance that when you took out student debt, it was a FFEL loan. And these FFEL loans, as they currently are ineligible for public service loan forgiveness and some of the other forgiveness programs that are out there. They can become eligible through consolidation, and consolidation, again, is a federal process, but the borrower would only be eligible for forgiveness from the point of consolidation forward. So I bring this up because one of the biggest reasons we've seen across the board for borrowers becoming or I should say, not being able to take advantage of years of service and work towards forgiveness is the fact that they have these FFEL loans. So identifying the loan type as early as possible is one of the things that Savvy helps the borrower to do. And if we identify that it is a loan type in which we'd want to take action, such as consolidation, in order to make that borrower eligible for forgiveness, we're able to do so early. That borrower is not going to find out 10 years later when it's too late that they have the wrong loan type, as many borrowers have unfortunately found out in the process of trying to apply for public service loan forgiveness. Direct loans, the direct loan program started in 2010, and basically most borrowers, if you took out loans past 2010, will have direct loans. And direct loans are eligible for public service loan forgiveness, and they're eligible for all the different income-driven repayment plans. So as long as you see the word direct next to your loan type, it is a direct loan. Another loan program are PLUS loans. PLUS loans come in two varieties, Parent PLUS loans and Grad PLUS loans. Now, Parent PLUS loans, I want to take a second here just to talk about these. Many people think that the student debt crisis is a young person's problem, for millennials. In fact, the fastest growing demographic of student loan borrowers is actually 50 plus. It's parents taking out loans on behalf of their kids. So a Parent PLUS loan is a loan taken out by a parent on behalf of their child, but in the parent's name. Now, that Parent PLUS loan, if it's consolidated into a direct loan, can become eligible for forgiveness. So that parent, say who works maybe for an eligible employer, is able to reap the rewards of forgiveness based on a loan that they took out for their child. Sometimes people often have questions around that and think that because their child doesn't work for a qualifying agency, that therefore they cannot attain forgiveness, when that's not the case. However, like I said, those need to be consolidated into a direct loan in order to become eligible. Another type of PLUS loan is a Grad PLUS loan. These are given to grad students, as the name might suggest. These Grad PLUS loans are eligible for everything straight off the bat, so they don't need to be consolidated at all. But again, not to go too far into the weeds here, these different loan types, the things that you see when you pull open your servicer statement, they might not have had meaning before, but they are, crucially important when it comes to identifying your options, especially when it comes to forgiveness. And so Savvy is going to be able to help you identify what loan types you have and make the best decision going forward. Federal loans are also eligible for income-driven repayment plans. And I'm going to talk a bit more about this in the next screen. But these income-driven repayment plans are a valuable tool and resource for borrowers who have especially a high debt-to-income ratio, such as myself. I will tell you, I have a little over $200,000 in student loan debt between undergrad and grad school. And I like to tell borrowers that in hopes that it makes them feel better about their own student loan debt. But for borrowers that do have a high debt-to-income ratio, especially, or even a particularly low income, anything under $20,000, they could be eligible for as low as a $0 monthly payment. $0. And so this could be a powerful benefit, but many borrowers just don't know that it exists. The program is very underutilized. And so what we really try to do is help borrowers to become aware of that and enroll in these income-driven plans. And ultimately, we see savings, like I said, upwards of around $200 a month on those repayments. Federal loans are also eligible for loan forgiveness. We focus on two main forgiveness programs in the Savvy platform: public service loan forgiveness, or PSLF, and teacher loan forgiveness, TLF. I won't spend as much time today on teacher loan forgiveness. That's a program for K through 12 teachers in Title I schools. But when going through the Savvy platform, we'll be able to identify, based on your employer, what eligibility you might have for either or. Last but not least, federal loans are eligible for deferment and forbearance. Deferment and forbearance is essentially a way to press pause on payments. Everyone goes through tough financial times, and the ability to sort of halt payments for a period of time, whether that be 3, 6 months or more, is a valuable benefit afforded to federal loan borrowers. These benefits are not available if you have private loans. Now, I would say one of the reasons why we talk about deferment and forbearance is that we find many borrowers will go into a deferment or forbearance, as the sort of the first solution when they're not able to make their monthly payment. When that monthly payment is way too high, they don't know what to do, they will call their servicer and automatically go onto a deferment or forbearance because it's the easiest thing to do. However, what we hope to sort of show borrowers is that they probably could qualify for a very, very low monthly payment, maybe, like I said, as low as $0 a month, by enrolling in an income-driven repayment plan. It just requires looking at, their income and tax filing status, and things like that. But by enrolling in an income-driven plan, instead of opting into a deferment or forbearance, that borrower is able to accrue credits towards forgiveness that they wouldn't otherwise be able to do. So when you're on a deferment or forbearance and not making payments, none of those months count towards forgiveness. But if you were enrolled in an income-driven repayment plan, even if it was a $0 a month income-driven plan, you could accumulate a credit towards forgiveness for each of those $0 payments. And when people hear this, they're amazed. So what we really want to do is just, there are times when that might be necessary, but we want to help borrowers look into their options so that they're aware that they don't necessarily have to opt into a deferment or forbearance right away. Next screen, Ellie. So just to look at repayment plans, when everyone graduates, they're automatically put into what's called the standard plan. And the standard plan essentially calculates your monthly payment based on the assumption that you're going to pay that loan off in 10 years. And so this is why for many people, when they get that first servicer statement from Navient and open it up, the estimated payment is very high, and it scares many borrowers. For example, if you have about $58,000 in student loan debt at about 6.8% interest, that's going to look like $667 a month, which is a lot. Now, that payment is based on that borrower's debt amount. And like I said, it's a 10-year payoff horizon. On an income-driven repayment plan, that payment is going to be capped at about 10% of the borrower's discretionary income. It also takes into consideration family size, tax filing status, state of residence, things like that. So for example, for a single borrower with no dependents and an income of about $52,000, that payment's going to go down to about $270 a month. Already a significant savings from what it might have been, if they were on a standard plan. For every child dependent that you have, that student loan payment is going to decrease about $50. So they really, the the more child dependents that you have, the better. Even unborn children count. I'll tell you a funny story. I had a borrower who was pregnant when we were applying for her income-driven repayment plan. So she was able to put down one child dependent, and about a month later found out that she was pregnant with twins. And so emailed us back, and we were able to resubmit her application and got her payment lowered even more because now she had two child dependents. So again, these are sort of the little things that factor in to help lower that payment and help the borrower even more. There are 4 primary income-driven repayment plans. These acronyms right here that say REPAY, PAY, IDR, ICR. You don't need to worry about those, and neither does the borrower. There are different eligibility rules around each of those plans depending upon when you took your loans out and things like that. Savvy takes care of all of that. That's what the technology is there for. Our innovative platform is able to identify exactly what plan is going to be best for you and alert you to that. So there's no need to really worry about which one is best or reading into the rules and stipulations. The 2 most important aspects around these plans, however, are as follows. They require yearly recertification in order to maintain eligibility in the program. So when you enter into an income-driven plan, you lock in a payment basically for the following 12 months. After that 12 months is up, you have a recertification deadline. Now, everyone's deadline is different depending upon when they entered into the program. I will say 56% of borrowers miss their recertification deadline. And when you miss your recertification deadline, what happens is you immediately fall out of the program and your payment goes right back to the standard amount. So your next month, you'll see a much higher monthly payment. And any interest that you accumulated over the course of that year is capitalized and tacked onto your principal balance. So I'll tell you from personal experience, a couple of years ago, before I started working for Savvy and know what I know now, I was on an income-driven repayment plan and missed my recertification deadline and didn't think much of it. Well, I recently looked back and saw that in about a day's time, I had $15,000 in capitalized interest tacked onto my principal balance, basically the next day after missing that deadline. And I had no idea that was going to happen. So at Savvy, one of the biggest things that we focus on is monitoring and alerting borrowers to deadlines such as these. So what we do is we work with the borrower and alert them 2 months before their recertification deadline in order to collect the proper paperwork, work with them to get that paperwork completed and submitted within plenty of time so that they're never going to miss another recertification deadline again. And again, this ultimately on these income-driven repayment plans, this yearly recertification is going to be necessary in order to stay on these programs, especially if you are looking to qualify for a public service loan forgiveness or any other type of forgiveness. And as it says right here, my last point, it is required for you to be on an income-driven repayment plan in order to qualify for public service loan forgiveness. And this is one of the big stipulations that many borrowers have missed out on, and the reasons why they've been rejected from the program. We're going to talk a little bit more about that in this next slide right here. Perfect. Thanks, Ollie. The income-driven repayment plan is a required part of being eligible for PSLF. And we'll talk about that now on this slide. So public service loan forgiveness, the major forgiveness program out there, essentially goes like this. The remainder of your balance will be forgiven, completely forgiven, not taxed, on your eligible loans after you've made 120 qualifying payments. Now 120, basically comes out to about 10 years. However, these payments do not need to be consecutive. So they just need to be cumulative. For example, you could start making, 2 years worth of payments on those loans working for a nonprofit and then go into the private sector for a couple of years and then go back to a nonprofit and continue right back where you left off in accumulating credits towards that 120. So again, they don't need to be consecutive, just cumulative. I will also say it is retroactive. So for borrowers that are just finding out about this program now, Savvy helps them go back in time, as long as it's 2007 onwards, to reclaim any credits they could have accumulated, whether it's under their current employer or previous employers. And for many people, this involves tracking down, former HRs and things like that. Savvy takes care of all of that, and you'll see how we do that later on in the presentation. So this screen, when I talk to borrowers and I go out into the field, this is probably one of the most important screens that I show them, because this really gets down to the crux of why people have been rejected from this forgiveness program and how you can qualify. So what is a qualifying payment exactly, is what we're going to outline here in front of us. So number one, you've got to work for a qualifying employer. So this is a government organization at any level, federal, state, local, or tribal, or a nonprofit 501c3. So when you go through the Savvy platform, and you'll see this in a few minutes here, we have a database of all the eligible employers for PSLF. When you start typing in your employer, it will immediately pop up, and we'll be able to identify from that the eligibility towards your forgiveness. Another stipulation around employment is that you must be considered full-time. Now, for borrowers that are part-time, say, at their employment, and that's a nonprofit, if they work at another qualifying employer, also part-time, they just need to work for a combined 30 hours or more in order to qualify. So you can make two different employers count as long as those hours are over 30, and that can be considered eligible employment. The second stipulation is qualifying loan type. You have to have the right type of loan. And this is what I was touching on earlier when it came down to direct loans and FFEL loans. So the only type of loan that is eligible for public service loan forgiveness is a direct loan, the direct loan program. Now, if you don't have a direct loan, so for example, if you have a FFEL loan, you can consolidate that loan into a direct loan in order to become eligible. However, you will only start accumulating credits towards forgiveness at the point of consolidation going forward. So, for example, what we often see, and it's sad, but it's part of the reason why many borrowers have been rejected from this program, is we'll see employees who've been working at a nonprofit for 10 years, who've been making payments on their student loans, who have been thinking that they're going to be eligible for forgiveness, and find out that all along they've had a FFEL loan. And therefore, none of those 10 years worth of payments can count towards credit for forgiveness. So they're basically starting at zero. And from that point forward, when they consolidate and turn it into a direct loan, they're able to start accumulating credits. So like I said, the earlier we can identify if you have this loan type, the better, because we'll want to take action right away. Third, you need to be on the right repayment plan. And this qualifying repayment plan is an income-driven repayment plan. Now, if you have been on a standard plan, either a standard extended or graduated plan, or the standard plan itself, we are able to potentially get some of those credits to count towards forgiveness. However, we need to move you over to an income-driven plan as quickly as possible. You have to be on an income-driven plan for the majority of time that you're making qualifying payments towards that 120. Also, I will note that each payment has to be on time and in full. Many borrowers ask if they're able to sort of make double payments, in a month and basically have that count as 2 credits. Unfortunately not. So these payments have to be, it's once per month for the amount that's due. One thing I will note on that, if you are currently in an in-school deferment or on a deferment or forbearance, essentially if you are in a situation where you're not required to make payments, if you are making voluntary payments towards your loans, those are not going to count towards forgiveness. You need to have sort of a bill due. You need to have a required amount due. So that would require just simply calling your servicer and essentially getting onto a repayment plan and opting out of whatever deferment or forbearance you might be on. But just keep that in mind. There needs to be an amount due that you are paying in full each month in order for that payment to truly qualify. So these 3 things: qualifying employer, right loan type, and right repayment plan. For most people, the qualifying employment is the no-brainer. And for the majority of the borrowers who came through and applied for the PSLF program, in 2017, which was basically the first year that people would have been eligible since the program started in 2007, many simply thought that based on their employer, the fact that they were a teacher, the fact that they worked for a nonprofit, was the only qualifying stipulation. And unfortunately, they learned the hard way that there are two other very important components to this, and that's loan type and repayment plan. And so these three factors, these are what Savvy really sort of focuses on as far as helping the borrower identify their current situation and then go, sort of work from there to get them onto the path of forgiveness and navigate going forward. Next screen. So just a bit on the PSLF landscape and current legislation as it stands. I get asked this all the time, and as I was talking about before, the massive rejection rate that happened when this program first came into existence. I will note about this, that most borrowers, I would say actually 80% of the borrowers who applied for forgiveness the first time around, 80% of them had yet to make 120 payments. So you can't even, consider yourself eligible for PSLF until you've made those 120 payments. So most of the borrowers who tried to apply hadn't even reached that point yet. Now, I will say that we track the forgiveness rates on a quarterly basis as published by the Department of Education. And each quarter, the amount of people that are getting forgiveness is increasing and increasing and increasing. And so, borrowers ask, is this program real? Are people actually getting forgiveness? The answer is yes. As more people are becoming educated as to the other requirements around the program, as the servicers in the Department of Education are better managing, borrowers and the program itself, the whole system is improving. However, that doesn't mean that we're going to rely on a servicer of the Department of Education. Savvy basically was born out of the need to help borrowers navigate this landscape of forgiveness. And so we really specialize in helping borrowers get onto the right path and ensure that year in and year out, they're working their way towards ultimately that 120 qualifying payments. I'm often asked if there were any current administration proposals to eliminate the program. If they were to go through, what would happen to, say, a borrower who's about 5 years in and was really counting on that forgiveness? The good news is that it would only affect new borrowers. All current borrowers would be grandfathered in. This is federal law. That's not going to change, so you don't have to worry about that. And in fact, the mood has shifted in the complete opposite direction. Last year, Congress appropriated a $350 million fund to expand the Public Service Loan Forgiveness Program. It's called Temporary Expanded PSLF. And the reason that they did this was essentially to help borrowers who had been screwed over by the process of PSLF. And so a temporary expanded PSLF borrower is someone who's made 120 qualifying payments on those loans, has been on the right type of repayment, the right type of loan, so they have a direct loan, but they've been on the wrong type of repayment plan. Okay, so they've made the 120, they have direct loans, but they've just been on the wrong repayment plan. If you think this is someone you know or yourself, please reach out to us right away because it is a limited time fund. So when that money runs out, that's it. But we are applying borrowers for this constantly because many, many people do qualify. And so they've expanded the program to help, accommodate those borrowers who really have, made those payments and deserve to get forgiveness if possible. Next screen. Now that I've sort of outlined all of the challenges around federal loans and forgiveness, how does Savvy help to sort of navigate this, and what do we do that sort of sets us apart, basically why we're here today? So Savvy essentially checks the eligibility and qualifications around PSLF and other forgiveness programs. Think of it as almost like a diagnostic assessment of that borrower situation. And in this case, it is a diagnostic assessment that's going to not only address where they currently stand, but basically show them the path forward to where they need to go. And especially for anyone who would need to consolidate their loans, things like that, we alert that to the borrower and we're able to help them do that right away. When you go to the Savvy platform, you're going to see a personalized repayment and forgiveness screen. This is basically going to be an overview of what we've identified as your optimal repayment plan. And if you're eligible, what that forgiveness could look like. And this, again, we take into consideration the calculations that we've sort of been doing through the platform itself as you enter in information, and we'll see in a second how that works. But this personalized repayments and forgiveness options is, I would say it's akin to a calculator almost. So I know there are a lot of calculators out there. However, one of the things that sort of really differentiates Savvy is when a borrower decides to select that plan, what happens next? And that's basically Savvy takes care of the entire paperwork and application process. And this is really something that sets us apart from sort of any other tool or thing like that. It's so much more than the technology that's on the page. It's essentially a full service offering. So what we do is we digitally sign and pre-fill all of the borrower's applications for them. We have an integration with DocuSign that allows us to set these documents up, send them over to the borrower for e-signature. Nothing gets printed, nothing gets lost. I will tell you that submitting applications to servicers, whether it's for forgiveness or whether it's to get onto an income-driven repayment plan, all of the application paperwork is really a hurdle for borrowers. Many borrowers submit and are rejected. They forget one page at the end. They leave a numeral off their social security number. The servicer will find any reason to reject that plan, and it only just slows down the borrower in getting onto the right repayment plan and being able to move forward, with their loans. So we really, in taking over this process, are able to ensure accuracy, but also able to ensure the success of the application itself. So when we submit that application, we are going to ensure that it is successfully approved, and that if it's not, that we work with the borrower and the servicer to fix any errors and make sure that it's in good standing going forward.
So
we take care of all. Yep.
Lindsay, can I just jump in for a minute?
Sure.
So we're going to go over the usual hour, and we'll still have time for questions. So just wanted to make everybody aware that this is an excellent presentation, and we'll give it the full time. So please hang in, and we'll probably go for an extra 15 minutes, the extra half hour, to make sure we cover as much as we can.
Yep, sorry about that. I just realized the time. We were actually going to jump this. This is the last sort of slide in the educational side of the deck. We're going to jump right into the tool after this. So please hang in there. We help you with all the recertification that is required yearly. So that's on your repayment and forgiveness plans. We're going to help you monitor for new programs and policy changes that are coming down the pipeline. We are literally located a block from the White House, but we work very closely with the Department of Education, the CFPB, other student loan advocacy groups, and we are going to be the first to hear of anything as far as policy changes, improvements, things like that are coming down the pipeline. And so we incorporate those into the tool as well as into our advocacy and education of borrowers. And last but not least, and I think this is probably one of the most compelling aspects of the Savvy sort of tool and service, is you're able to receive one-on-one support with our student loan experts. This is, as a student loan borrower myself, the ability to talk to someone who you can trust, who is looking out for your best interest, is invaluable when it comes to student loans. Many borrowers, or I should say most borrowers, are coming to us from a negative experience overall. I would say no one really likes to think about their student loans. Anyone's interaction with their servicer on the whole has probably been negative. And so we really help to change that perspective on their debt and on their future. And so a borrower is able to call in and talk to us anytime. They're also able to schedule callback times based on their convenience. And I think one of the biggest aspects around this is, we develop a relationship with the borrower that's long-term. We're going to be helping them with these programs year in and year out. And it's often a very long-term process that requires patience on both ends. And so there are many touch points along the way, and we are there, for each one to sort of see the borrower through that next stage, and to make sure if there are ever any issues, if they receive a letter from their servicer that seems alarming or anything, they forward all that to us, and we're the ones who can address it and monitor and make sure that everything's okay. So it's borrowers who have received forgiveness describe it as a full-time job to try to attain that. And that shouldn't be the case, but that's why Savvy's here. You have your own full-time job. Let Savvy be your full-time student loan sort of guru. So with that being said, if we go to the next slide, this is a look at the Savvy platform, specifically a domain that we've built for NHRC. If you go to nhrc.buysavvy.com, you can access the tool. But essentially, we've designed and built this site specifically for the agencies that are affiliated with NHRC. You guys here on this call today, but this is where you're going to be able to access Savvy for the first time. And so this is a look at what we like to call sort of the home screen. But essentially, we start out by asking borrowers two very simple questions that we think any student loan borrower should be able to know and answer easily off the top of their head. And that is what your expected income for this current year, for 2020 is, and how much you're currently paying on your federal student loans. Just a rough estimate. These don't need to be exact figures. If we go to the next screen, by just entering in those two amounts, so in this case, the borrower's expected income for 2020 is $40,000, and their current student loan payment is $477. They click Get My Estimate, and if you go, perfect. And just by running a quick algorithmic assessment based on those two factors alone, their income and their current payment, we're able to identify that this borrower could lower their monthly payment to about $177, which is a savings of about $300 a month. And that's, again, just looking at an income-driven repayment plan. We haven't even yet touched on whether or not they're eligible for any forgiveness. So if we click Let's Get Started, it'll bring them into the tool. And it sort of has the look and feel of a TurboTax from here going forward. We're going to ask the borrower questions around their taxes, income, and employment. And this all helps us to identify the best options available for that borrower based on their situation. So in this case, they're going to answer questions like what state do you live in, your tax filing status. That number in the bottom left-hand corner, that $121 a month, that's already lowered down to $121 from the $177 we projected on the previous screen, based on the fact that they have a dependent and that dependent is a child. So that it updates in real time based on the information that the borrower is entering into the tool. It also includes smart skip logic. So if this borrower had indicated that they were married, we would ask a whole subset of questions in regards to their spouse. Because if your spouse has student loan debt, that can help to lower your student loan debt as well. But also, most of these applications are going to require your spouse's signature. So we have all of that built in to be able to send your spouse the form to sign, also electronically, and again, make it easy for all parties involved. So if we go to the next screen, here we're just going to ask and confirm some information about your income. One of the things that we ask and that borrowers are going to have to enter in is what their adjusted gross income is as reported on their 2019 federal taxes. Now, I will say right here, many people, including myself, well, I shouldn't say many, maybe I'm in the minority here, might not have filed their 2019 taxes yet. That's okay. They have the option to use their 2018 tax return. So it's essentially the most recent tax return that you have available. But if you click to the next screen, you'll see, say you didn't know what an adjusted gross income was. There are green question marks to the right of every question. We call these tooltips. These give sort of a more in-depth explanation of what the question's asking. And in this case, where you can find that adjusted gross income. For example, it says on Form 1040 of your tax return, line 37, and we've even included a link where you're able to access your tax transcript from the IRS website, because many people don't have, their tax returns just handy on them, whether they're going through the tool on their phone or whatnot. So we make it really easy for you to find any of the information that we need to collect. And going to the next screen, we're going to gather some information around the borrower's employer, or current employment, I should say. So in this case, the borrower has identified that their current employer is Tides Network, which is in our database of eligible employers. After we've confirmed that that borrower works more than 30 hours per week, so it's full-time, we've identified that that's likely eligible for future loan forgiveness. And you can see in the bottom left-hand corner that there's that green words right there that say likely eligible for future loan forgiveness. That pops up as soon as the borrower starts entering in their employment information, and we've identified it's eligible. We also ask if they previously worked for any nonprofit. Oh, sorry. If we can go back for 1 second. Oh, perfect. Thanks, Ellie. So did you previously work for any nonprofit or government organizations? So we asked this question because, as I think I mentioned earlier, we work not only to sort of help the borrower with their current employment, but if we need to get certification of any past employment for a borrower in order to get credit from previous years to count towards forgiveness, we do all of that. We do all of the legwork there. So we essentially simply ask for that borrower's previous employer and the name of an HR contact or any contact at the organization, and we'll usually do the due diligence to find out who would be necessary to sign off on these forms. We prepare them, and the borrower doesn't need to basically do a thing. They sign off on their portion, and we're able to send it to their previous employer to verify their length of employment, and it comes back to us. You know, all sort of can happen in a matter of minutes, really, and we're able to submit it to the servicer on the borrower's behalf. Continuing on, at this point, the borrower is going to be prompted to register for an account. This is going to allow the borrower to save any of the information they've input so far, but also, as we see on the next screen, we're about to sync our loans, which is one of the coolest aspects of this tool. So creating an account is very simple, just first, last name, email address, and password. Again, this allows the borrower to save this information, and they're going to get a welcome email into their inbox as soon as they register. So with syncing the loans, many borrowers have anywhere between 5 to 6 loans on average. I have about 13 myself. Some have them with different servicers. Some have loans and private loans. All of the loans are different types potentially with different balances, interest rates, disbursement dates, all of this data. If anyone knew all of this off the top of their head, I would be very impressed. But also, in reality, these numbers are changing from week to week simply based on interest that's accumulating and things like that. So what we do by syncing these loans is basically pull the data from the actual servicer and get the most accurate and up-to-date information around the borrower's student loans into the tool on our end. So if you go to the next screen, essentially what you're able to do is identify which federal servicer you have and enter in your login credentials for that servicer. So in this case, Navient, my username and password. By pressing submit, it's going to pull in all my student loan data from Navient, the most up-to-date and accurate reflection. And that way, Savvy is able to sort of identify with the highest accuracy what I'm going to be eligible for going forward. And so it takes a matter of seconds, and we find that it's really helpful in helping the borrower determine their best options going forward. Now, for anyone who doesn't feel comfortable entering in their login credentials, we are fully vetted, by many security firms. We take security very seriously, but we understand that they might not want to, so they're able to add their loan details manually if they prefer. This loan review screen is a look at what you see after you've synced your loans. So in this case, I've synced a loan from Navient, that's about $35,000, and one from Great Lakes. You're able to sync from different servicers, multiple servicers, and even sync private loans. I will say one thing about private loans. While private loans don't qualify for these income-driven repayment plans or forgiveness programs that we really focus on, they are an important part of a borrower's debt picture overall. Many borrowers will have private loans and federal loans. It's rare to see just private loans. However, we encourage the borrower to sync their private loans as well as their federal, and they would do it the same way they would sync their federal loans. They can type in or enter or select the private servicer on the screen and sync that data over. And what we do on our end is we flag that it's a private loan, and we reach out from support to work with that borrower and see if potentially refinancing might be an option. Because the loans are already private, there's no risk of losing any federal benefits by refinancing. And just to clarify around that, when you do refinance your student loans, refinancing essentially turns any federal loans into a private loan. And when that happens, you lose all of the benefits afforded to you under the federal system. So there's no more income-driven plan. You're no longer eligible for forgiveness. No more deferment or forbearance. So for borrowers who are eligible for forgiveness, we really caution them against trying to refinance their student loans for the sake of taking advantage of that federal benefit. Not to mention, less than 1% of borrowers are actually eligible for refinancing. It requires an incredibly high credit score and income. The average SoFi borrower makes over $100,000 a year. And that's just not your average borrower, and especially the borrowers that Savvy really tries to work with and help the most. If you go down to the next screen, this is the last and final question screen, and we call it a miscellaneous screen for a reason. These are just sort of a few last questions that we're going to ask the borrower in order to really nail down exactly what their current situation is, so that we can determine what their best situation might be going forward. So things like, have they ever changed their repayment plan? When did you make your last payment? Are any of your loans from grad school? And when did you start repaying your federal student loans? All of these questions are very intentional. We ask them in a way that makes it so that the borrower can easily answer. While at the same time, we're able to gather the information we need in order to flag anything if necessary. So for example, if the borrower has indicated that they had not made a payment within the last 9 months, that's a red flag going off for us that, okay, we perhaps need to check in with that borrower and the servicer to make sure that the borrower has not fallen delinquent. We ask when you started repaying your student loans, so we have an idea of how long you might have been making payments for, so we can estimate how many credits you might have accumulated towards forgiveness thus far. If you go on to the next screen, at this point, you're going to have reached what I like to sort of call the results page, but this is a look basically at what we've identified for you as your optimal repayment and forgiveness option. And I say forgiveness for those who are eligible. So in this case, we've identified that the REPAYE plan, REPAYE, that's an income-driven repayment plan, is going to be the best, or potentially the best option for you. We indicate what your new monthly payment would be. So in here, it's $121.96. We indicate what that monthly savings is going to look like. So this person is saving about $350 a month compared to their old student loan payment. And we look at their projected forgiveness amount. So in this case, this borrower's projected forgiveness is $77,000, which is quite significant. We also take a look at other repayment plans that the borrower might be eligible for. So when you're going live to the tool, you're able to scroll down and see what the other options are that we have identified. However, the one that we selected for you up top is the one that and the sort of the innovative technology that we've built into this tool have identified as going to be sort of the optimal plan for the borrower. If the borrower chooses to press select and enroll in that plan, at this point on the next screen, they're going to be prompted to enroll in what's called the Savvy Essential Plan. So we are very upfront about the fact that these are all federal programs that the borrower can enroll in for free online through the Department of Education website. And so we offer a DIY option, essentially. So up to this point, the borrower has basically been able to enter in their information, sync their loans, and get a personalized repayment and forgiveness assessment of what would be their ideal situation. We've indicated the plan that they should enroll in, and what they can do then is say, okay, I'm going to go enroll in REPAYE on my own. I'm going to go to the Department of Ed website, and I think I can do this. And we even help them with the paperwork process. We indicate all the links where they need to go in order to do this. So that's part of the DIY, and that's no cost at all to the borrower. However, if the borrower wants to enroll in the Essential service, that's where Savvy really picks up and does all the heavy lifting going forward. So they've identified that they want to enroll in this plan. Now everything turns over to Savvy, and we take care of all of the paperwork, ongoing monitoring, and you really get access to that premium level of support. I would say, I talk to borrowers sometimes, 4 or 5 times over the course of, a couple of weeks while we're looking at their different options, and they just want to call and ask questions and things like that. That is part of the essential service that borrowers really seem to appreciate and value. Now, I would say that for NHRC members, the essential price is discounted even further than what you see here on the screen. So Savvy's retail price is $89.95. Savvy is not a direct-to-consumer product. So we are not available to just anyone off the street who wants to come and use the product. We are only available through partnerships such as this one. And so it's really sort of an exclusive benefit that we customize towards specific audiences. And in this case, this pricing of $60 a year, a discount on that price, is what we've negotiated for NHRC sort of affiliated borrowers. However, for those that are part of
Lindsay,
yeah,
can I just add?
Yeah.
So that pricing's available to any HUD-approved housing counseling agency. So that's the sort of definition of who qualifies for that.
Yep, perfect. Thanks, Bruce. And then as far as member pricing goes, it is an additional significant discount on that. That brings that essential price down to $35 for member NHRC member agencies and organizations. And so for any member organizations on the line right now who are interested in obtaining that discount, reach out to either Bruce, myself, or Ellie, and we can instruct you on how to go about doing that. But again, we've arranged for this borrower through NHRC to receive a $60 a year essential plan. There's a 100% money back guarantee on any essential sign up. At any point in the process, we could have enrolled you in your plans. We could be working with you for a year, and if you would like your money back, there's no questions asked. We're happy to do so. We really have found that borrowers are more than willing to engage us on any type of assistance we can provide them around this paperwork and monitoring. And so it becomes a sort of a no-brainer for many borrowers going forward. So if the borrower decides to enroll in the essential plan, on the next screen, I believe they would see, so this is just a look at what the payment screen would look like at that point. But on the next screen, once they'd purchased the plan, okay, so we're gonna look at so this is just a quick look at what we call the dashboard. So when a borrower signs into their account, and they can basically have access to their account, their Savvy account, 24/7, whenever they want, they can go to the site and, now that they've registered, they can log in and access their account and see what the status of their application is. So in this case, looking at the dashboard, the borrower is on the select repayment plan step, and that blue continue application, they're able to click that button to continue back onto their application where they were before. Each of the aspects of this dashboard were designed to really keep the borrower informed as to every step of the process and what they're going to need to do, where they are in sort of the larger landscape of their repayment. That way, there's never any question as far as the borrower is concerned about what's going on. So if you go to the next screen, this is going to look at what a borrower would see under submit application. So it basically it walks through all the necessary steps that need to be completed in order to submit that application. So things like attach necessary documentation. That's the supporting documentation like your tax return or pay stub that we're going to instruct you to attach to the digital forms that we're going to be sending you. Sign application. Savvy received your application and Savvy's reviewing your application, and application sent to servicer. Each of these steps, once it has been completed and moves on to the next step, will be highlighted and indicate such. So a borrower can log in and really see in real time where they are in the process with Savvy. If you go on to the next screen, this is a look at the digital enrollment that I was talking about as part of this essential feature. Here's an example of the income-driven repayment plan application, just the first page. It's actually a 6-page application. But in going through the platform, Savvy has collected the information we need to completely pre-fill this entire application, aside from your social security number, which would be entered into that little red box up there. We don't collect or store those. The borrower will be able to enter that in, scroll down to the bottom, place their e-signature, attach their supporting documentation right to the document, and press submit. And it comes back over to our end for review, and then we're able to submit right to the servicer on their behalf. They don't touch a thing. On to the next screen. Oh, perfect. And Bruce, I'll wrap it up here. We're almost done. I apologize, everyone. We're going to see now what that loan forgiveness certification looks like on our end as well. So I'm going to show you on the next screen. Ellie, if you can just click one more forward. So this is a look at how we digitize the Public Service Loan Forgiveness Employment Certification Form. This is one of the critical forms for borrowers who are looking to track their progress towards public service loan forgiveness. It is a two-page form. The first page filled out by the borrower. So we've pre-filled the borrower's information and have indicated where they're going to be signing and entering in their social. And we send that to the borrower to collect. And then the second page is what gets filled out by that borrower's employer. And what we do is we go ahead and pre-fill as much of this as possible for the employer. And we've already collected the contact information of where this is going to be sent. And so we're able to then electronically send the form directly to the contact of the employer, who can sign off and verify the dates of employment. And then once they do that, it comes right back to us. We're able to review and we submit to the servicer. I would say that this is probably one of the most tedious aspects for borrowers as far as tracking down HR employers. But also when we work with organizations, it makes the lives of anyone signing off on these forms a lot easier. It basically allows us to identify a single point of entry, and for an organization to essentially say, all of our employers or all of our borrowers are eligible for forgiveness. You're going to help us administer all of the documents around forgiveness for our eligible employees, and we can do so all of it electronically. And so it really helps as far as not only the borrower, but with the employer as well. This is a look at sort of the congrats you're done screen when you've reached the end of the process, the end of the online platform. I show this screen because it's sort of an example of one of the many touch points that we have along the way, because we feel that communication with the borrower is key. We rely on the borrower to notify and update us of the communication they receive from their servicer. At the end of the day, when we submit these applications to the servicer on the borrower's behalf, it's the borrower who will find out the results of that application, not us at Savvy, because that's that is the secure private relationship between the servicer and the borrower. That doesn't change. So we rely on the borrower to just simply forward any of that communication that they get so that we can monitor their progress and continue to make sure that they're on the right track. And when things go wrong or things are taking a long time, the borrower is able to flag that for us, and we're able to work with the borrower and reach out to the servicer on their behalf to inquire and see what's going on. And I think last but not least, there's one more screen here. This is just a look at sort of the support channels available to the borrower when going through the platform. They can click Contact an Expert, that screen on the bottom left-hand corner, that little box, which pops open this window. And they're either able to start a chat with us, or they're able to call our toll-free number anytime, Monday through Friday, between 8:30 a.m. and 8 p.m. And the green support button on the bottom right-hand corner of that screen that's on every page of the platform, you can click that at any point and send a message directly to support. And we usually get back to borrowers within 24 hours. But again, anyone on the Essential plan pretty much has access to a designated expert on our end that they were going to work with in continuation going forward, and are able to contact that person at any point in time. And so at this point, that I believe is going to be it for the platform itself. I'm happy to open it up to questions. I apologize for going so over, but I hope that sort of gave a thorough look into the tool, and ask away, if anyone's still on there.
We do have several questions. So a few people asked about if the amount of forgiveness is turned into taxable income.
So under public service loan forgiveness, no, it is not considered taxable income. However, if you are not eligible for forgiveness and are enrolled in an income-driven repayment plan, so this is essentially going to be me because I do not work, Savvy is not an eligible employer. On an income-driven repayment plan, after 20 to 25 years, which is the payoff horizon for those plans, the remaining balance on your loans is technically forgiven. However, that forgiven amount is considered taxable income. So you might have seen or read articles around that. It's when you're only on an income-driven repayment plan and are not eligible for forgiveness, that's taxable income. Under PSLF, the entire balance remaining is forgiven and not taxed.
Okay. Let's see. Is there any assistance for borrowers who made the 120 payments under the income debt repayment but wrong loan type, since they weren't informed about that they had the FEL, not direct?
Unfortunately, no. And I really feel for you because so many borrowers are in that situation. I would say, at this point, consolidating those loans is going to make them eligible going forward. But depending upon how much debt, left over you have, we might be able to find other ways to just simply lower that payment or work with you to figure out what your desired outcome is, to sort of help you optimize it at this point. Many times borrowers, say, I'm not going to be working for that much longer, and so we decide to go another route. We don't necessarily have to consolidate it, but if you do want to give yourself that opportunity to become eligible for forgiveness, unfortunately, none of those previous years will count, and we need to consolidate as quickly as possible.
Okay. What options does someone have who is disabled and their student loan entered into garnishment?
So I'm glad that this got brought up. I will touch on this sort of two aspects here. No matter where you are in the student loan cycle, I should say, in the life cycle of your student loan, whether you are in default and potentially getting wage garnished, Social Security offset, sort of at the most severe, whether you are delinquent, you're a couple months behind, maybe you're not sure, maybe you haven't heard from your servicer in a while, you think they've stopped collecting, maybe you have been making on-time payments, maybe you're even on an income-driven repayment plan already and have already certified yourself for PSLF. Wherever you might be, Savvy can help you and can still be used going forward. And so we're able to sort of address any borrower at any point. So for those that are in wage garnishment, we recommend that you reach out to support. I would either send a message via the platform, or you're able to call that number. But we work with that borrower one-on-one to enter them into a rehabilitation plan. It's often a 15-minute phone call that we're able to sort of get them set up for a rehabilitation plan for a 9-month period that will basically rehabilitate that loan. It'll go back into good standing. It'll come off of their credit report, and they're going to be able to, going forward, qualify for income-driven repayment plans as well as forgiveness. Now, that garnishment is particularly tricky because we're going to need to submit a separate sort of separate application around that that's going to require a lot of work with the borrower in terms of collecting their bills and things like that, so we can sort of make the case that the garnishment has to stop. As far as the disability goes, if this person is 100% disabled, they are eligible to have their loan completely discharged. So if that's the case, then we definitely want to work with them to see what resolution could be had there. But wage garnishment is definitely, we see it with many, many borrowers. It's unfortunately with federal loans, they're not going to forget that. they're going to continue to come after you. And so oftentimes, if you haven't been making your payment and you're maybe not sure if you're in default, please reach out to us or encourage anyone to do so, because it's much, much easier to rehabilitate that loan before it reaches wage garnishment. Once it hits that point, you're at least looking at another 4 months of garnishment before anything is able to be lifted. And so, again, reach out. It's a 15-minute phone call oftentimes that can turn someone from, being extremely anxious and worried about their student loan and thinking that they're going to have to pay, $1,000 or $2,000 up front, to basically getting onto a rehabilitation plan where they agree to a $5 monthly payment for 9 months, and it rehabilitates their loan. So just sort of a tangent there, but for this borrower in particular, depending upon their level of disability, we might be able to look at full discharge on those loans.
Okay, we do have quite a few more questions. So,
okay, yeah.
When syncing loans, will this show as a hard pull on their credit report?
No, absolutely not. We do nothing that reflects or affects credit. This is simply syncing into your student loan servicer account. It affects it in no way whatsoever.
Okay, so a few people wanted to know, is this price available for the employee of the HUD nonprofits, or is this also available for clients, family members, so on? So that a few people wanted to know the answer to that question.
Yeah, and Bruce, correct me if I'm wrong on this one, but that $60 price is available to all of the above that you mentioned. Would that be correct? I would say, especially any clients and employees, but we also, in most cases, family members are eligible for that same price as well. But Bruce, is there anything that you would want to add on that, or?
So I will add. I'm sorry.
Oh, okay.
We may have...
No worries.
Well, I'm here. I'm sorry.
Okay.
So that's exactly right, and it's you'll have the link, and it's appropriate to give it to your staff members, and it'll be appropriate to give it to family members, and it'll be appropriate to give it to clients.
Okay.
And similarly for the discount for if you're an NHRC member, that's a separate link. We'll distribute that on Monday to member organizations that are caught up on their membership dues, and you can use that for your clients and for your staff, and it's appropriate for family members as well. But that's a different link to get to the discount.
And we'll note that price is yearly. It's not monthly, just in case that wasn't clear.
And so somebody also asked, when will the program be available for us to use with our clients? And so people should know that the link that has already been shared is a link that you can go in and utilize.
Yep, it is live right now. So if Ellie, if you actually want to go back to that screen, probably 10 screens back, it has the link at the top, but I can also, I'm not sure if you're able to enter it into the chat, the Q&A box itself. But the link is nhrc.bysavvy.com. I think it's a couple more back.
I see it on the, okay. All right, so it is at the top, at the very top right. It says Lindsay plus NHRC at.
That's my email. That's my email address.
Oh, okay. So that's not it. Okay.
If you go back, if you were headed in the right direction. Yep, keep on going. A few more. There we go. Perfect. And I would recommend just, it's an easy way to sort of keep track of that link. But if you want to, when you're on this screen, nhrc.bysavvy.com, instead of entering into the tool by entering that your income and your payment, on the top right-hand corner, you can simply just click sign up, and it'll allow you to register right from the beginning. And when you register, first name, last name, email address, password, it'll send you a welcome email. And from that welcome email, it'll directly link you back to the site. So that way you'll always have access. So I often recommend that for some borrowers. Maybe you don't have time to go through it now, but you want to make sure that you have it for later. That's a good way to make sure that happens.
Okay. If a borrower made continuous payments for 7 years and decided to go back to school for a higher degree, once they completed and started back on the payment plan, does the prior 7 years count?
Yes, it does. And I'm assuming they mean count as in count towards forgiveness. it would count. You basically continue to accumulate credits towards forgiveness on those loans. If you took out more student loan debt to finance the education that you went back to school, for example, grad school, those new loans would basically start accumulating credits, when you started repaying them as well. So, for example, almost think of every loan you have as a different horse in the race. So those loans that you've been paying on for 7 years, they're going to have, quite a few built up credits towards public service loan forgiveness. Those loans that you just took on might be, at zero, right? So they're going to be, inching up, and they're going to be sort of behind the other loans that have been accumulating credits for, those 7 years. But that stays. We have borrowers that it's taken them, I should say upwards of 10 years, but it's very rare that I've seen a borrower who's attained forgiveness in 10 consecutive years. Many people go on to, for deferment or forbearance periods here and there where they're not accumulating credits and things like that. So, it is a cumulative process. As long as those, credits were after 2007, it's fair game. And you can go do something else for 5 years, 10 years, and then come back to it if you want. So it's just cumulative.
And is the fee a one-time fee?
The fee is a yearly fee. So it basically, you're going to, when you enroll, that Savvy Essential plan is good for the next 12 months. So you get basically 12 months access to all of the Savvy Essential features. And then after 12 months, you'll be prompted to re-enroll, at which point you can either decide, I think I'm going to do it on my own now, or you can continue to re-enroll. I would say, I see it as a success if a borrower, after their first year with Savvy, feels that they are educated enough to do it on their own. We support that fully. Like I said, we are the borrower first. We're behind the borrower, and that's why we provide that DIY option to make it easy for those who want to explore on their own. But we just feel very strongly that we know how that goes for many borrowers, and so that's why we offer the Essential Plan in order to help them.
Okay, so for clarity, somebody is asking, so the agency signs up and pays a yearly fee, the client then completes the application, and if they choose, pay the same fee as the agency to Savvy. Is that correct?
So the agency is getting access to this platform, and they're basically giving access to anyone within the agency. So the people who are paying the fee are the individual borrowers. So, a certain agency, might distribute this to their employees or whatnot, and the agency is not paying any fee, separately. It is only the borrowers who choose to engage with the platform and sign up that are going to pay a fee. So it's on a borrower.
So the counselor, if the counselor has a student loan and wants to use this and wants your full service, it's $60 for the counselor, and then if the client wants the full service, it's $60 for the client.
Yes, exactly. Yep. Every borrower has to have their own account.
That everybody understands that. Okay.
Yep. Same with family members too. So if your spouse also has student loans, they will need to create their own separate account. So as far as, and that's going to help them determine their best repayment plan and things like that. But don't try to add in maybe your daughter's loans onto your account. You want them to create a separate account for themselves.
Do you work with borrowers in default? I think that you talked a little bit about that in the previous question about the person with wage garnishment.
Yep, we work with borrowers in default all the time. I would recommend instead of necessarily going through the full platform, I would recommend messaging support via the green support button, or I can give you an email address to our support. And I don't think that this is included on the slide. Ellie, is there a place where you might be able to write this in on the Q&A chat so everyone can see it?
What am I writing in?
Just an email address. It's partners.
Oh, yep, go ahead.
partners@buysavvy.com.
Okay.
And go ahead.
So it's in the chat box.
Oh, perfect. Okay. So if you want to email that will create a ticket for us on our support team end, and we'll set up a time to call you and chat through your options as far as default go. But we basically will want to get in touch with the credit or collections agency where your loans are right now. And we'll be able to, again, try to get you onto a rehabilitation plan. If you've already been on a rehabilitation plan and maybe fallen out of it, we also have consolidation available to us, but we help borrowers in default all the time. That's why I said, wherever you are in the process, sometimes borrowers don't even know if they're technically in default. Just reach out to us, and what we'll do is we'll set up a time to chat, and we'll get on the phone with the credit agency, or the collections agency, I should say, or the servicer, and we'll sort of lead that call for you. So that we're your advocate. We're going to help you navigate every step of the way.
Okay, there's quite a few questions. I don't know, Bruce, if you want to go through all of the questions, or if we want to move on.
Well, I think let's ask a few more. I mean, I think we've got a fair number of people still on the line, and it's an important subject, and we're recording this, so people can use tap into it.
So somebody's asking about adding the link to their website for easy access for clients.
Well, that's a tricky one. I mean, we definitely, the problem is it really is meant for HUD-approved housing counseling agencies, and that becomes it becomes something that's out in the public domain. So we probably don't want that, but we should think about what an easy way to. I mean, fortunately, the link is an easy one to write down. So I'd say probably prefer not to have it on a website that everybody has access to, and really keep it to your client base and your staff or family members.
Okay. Okay. So let's see. I'm sorry. There's more questions popping in.
Well, I was just going to suggest
somebody's asking if they're a member organization and they are getting the significantly reduced rate of $35 as a member organization. Can the agency choose to pay that on behalf of their participant?
Sure, not a problem.
Is that what they're okay? I don't know if that's what the question actually is.
And the thing is that they'll have to walk through with a client. I mean, at the point when you pay on a credit card, it could be your credit card as opposed to the client's credit card.
So what we can
I just want to repeat to everybody so that it's clear that each individual person that decides to use the full service of the Savvy website pays the fee. So it's not a one-time fee for everybody in your organization. It's a fee per person within your organization, or that you're working with client-wise.
I would say, just to add on to that too, if there is an agency that, as you had mentioned, perhaps might want to pick up the cost for any other borrowers that are enrolling, reach out to Bruce about that, because he can connect with us. We have the ability to issue a sort of a coupon code, and you can even see that on the enroll screen, where essentially it will give the borrower a coupon code to enter in there, and it'll waive the fee for them. So, and we basically, can invoice the organization or agency for however many, coupon codes that they need for their borrowers who they're trying to cover the cost for. So there are ways that we can do that, that we sort of do that officially. So just reach out to us if that's something, if you're interested in for your organization.
All right, let's see. What happens when a student loan borrower dies? Will the government go after the person's assets?
Yeah, so with federal student loans, your loans die with you. I actually get asked this question quite often. So you don't need to worry about that. Private loans, on the other hand, have different stipulations, and it depends on the lending agency. But with federal student loans, they don't get passed on. And so, they won't get tied to your children or your next of kin.
What other types
they are discharged upon death. Sorry.
Okay. What other types of organizations do you work with? Financial counseling agencies, nonprofits, et cetera?
Great question. So we partner with as large of organizations as Fortune 500 companies like TIAA. We also partner with some of the biggest unions in the country, NEA, the big teachers union, SEIU. We partner with Comcast. We work with Comcast employees across the nation. We partner with Edelman Financial Associates or advisors. So these are financial advisors that use the Savvy platform with all of their clientele. And we are constantly expanding our list of partners and growing, every day. But those are just sort of some of the bigger partners. A lot of associations and membership unions, National Association of Social Workers, Alliance for Strong Families and Communities, institutions like that, the National Association of Community Health Centers. We're a social impact company, and we really try to help people. It overlaps with helping people who are eligible for forgiveness. Oftentimes, that these are the people that are doing good work in the communities, and so these are the organizations that we partner with.
And can people find out about how to partner with you and about who your other partners are by going to your website?
Yes, you'll be able to see if you go to buysavvy.com. There's a tab called Partners, and you'll be able to submit a request to basically get in touch with our partnerships. It'll come back to me, but that's the way to sort of officially do it. But yes, absolutely.
Okay. And do you help people who have private student loans?
We do. So as I mentioned, obviously the emphasis of our platform is around federal student loans. However, we are actually incorporating, and this is going to sort of launch very soon, an integrated refinancing option for people with private loans. But again, if you have those private loans, you can sync them to the tool. And because they're private, we'll flag them on our end and reach out to you in order to discuss next steps. Oftentimes, for many borrowers, private loans, those payments are very high, and they're looking at very high interest rates. And so we'll work with them to see if there's any way to potentially lower that payment with the lender itself, but also look into refinancing options if they're eligible and what those would look like. We're going to be partnering with a wide range of refinancing companies, to give borrowers options there.
Okay, somebody is asking if Savvy is available to be a presenter at a forum.
Absolutely, yes. I travel all over, and we do this all the time. But we'd be more than happy to.
And so, should they go through your website again to request that?
Yeah. Or if you want, you can give, maybe if you want to type this into the QA, you can give them my direct email address as well, since I handle sort of all those partnership things and requests.
Okay.
If you're okay with that, Ellie, you can give them to Lindsay@buysavvy.com.
Okay. So just so people know, I am popping it into the chat box right now, so that if you want to email Lindsay. Okay. Does Savvy partner with credit unions?
We do. We are in the process of a few partnerships actually with some credit unions. PenFed being one of them. We also work with NFCC, National Federation of Credit Counselors, but none sort of that we can officially purport at the moment right now. But we'll work with any type of organization really, but that's one that's definitely on our radar.
I think that is all of the questions.
So I'm going to add one more to the list, which is, I have let's say I'm running a housing counseling program and I have employees who have been around for 3, 5, or 8 years. Can we file retroactively to document people's employment under the public service option, assuming they're on the right loan program?
Yep, absolutely. we can definitely do that. And whether it's with, that agency or perhaps with another agency, when they go through the tool, they'll be able to enter that information in, and we'll be able to help them collect the necessary, signatures on that paperwork to be able to claim those credits. So yes, many people are doing this retroactively, I should say. But going forward, one of the reasons why it's so important for borrowers to sort of get on the right track early is because when you do have to go back and count those credits retroactively, oftentimes this is where borrowers run into issues with FedLoan taking an extremely long time. And when they come back, with the credit count, it's often, marginally less than what the borrower expected it to be. And so this is one thing actually, and I'll mention this sort of as the last thing, where Savvy really steps up as far as an advocate. Many borrowers who are trying to get forgiveness, and you can read this probably on blogs and articles, all over the place, face difficulties with the servicer not counting their credits correctly, and sometimes just not even hearing back from their applications. And so this is where Savvy steps in. We have the ability to trigger a third-party review through the Department of Education Ombudsman system. And we essentially will be able to file a complaint that will trigger a review and make it federally mandated for your servicer to respond back within 15 days. And so what it does is it escalates your situation. And for the borrowers that I've worked with, it has been 100% successful in getting the servicer to take action that we wanted it to, and to get back to the borrower. And oftentimes this has led to their successful forgiveness, or they finally heard back and they've addressed the issues, surrounding counting their credits properly and things like that. So this is something that we often use at our disposal, along with submitting complaints to the CFPB. But we really hold the servicers accountable because, again, this is where they have really screwed up the process for many borrowers. So if you have submitted things and you've been rejected, or you're having a tough time managing that, please reach out to us, because again, this is where we help to manage that relationship going forward. But encourage, especially for any new employees or early employees, we want to encourage people to get tracking on this as early as possible, because that's how you avoid delays and running into problems, going forward. But it is definitely possible, and we're sort of the workhorse behind that to make it easier for the borrower.
So one more thing kind of popped in. Can you mention the interest capitalization again?
Sure. So when you are on an income-driven repayment plan, oftentimes, and the goal, so let's say the goal being to qualify for forgiveness, and you're eligible for forgiveness, we want to try to minimize your monthly payment to maximize that forgiveness. So say you are eligible for a $0 monthly payment because your income was so low, right? You're making a $0 monthly payment, which basically is not even covering, or obviously, any interest on your loans. And so when your monthly payment doesn't cover the interest portion of that payment, that interest sort of continues to accrue basically and build up throughout the year. And when you miss the recertification deadline for these income-driven plans, that interest then becomes capitalized interest on top of your principal balance. So essentially, it will get taken and tacked right on as if you had more loan than you even had to begin with. And this is why borrowers, we see this many times, borrowers have been paying on their loans for 5-10 years consistently, and their balances are higher than when they started. It's because of this interest capitalization. And so, again, it's okay if our goal is to ultimately, make you eligible for forgiveness, and you're going to get that forgiven. We don't mind, sort of that interest accruing. Again, we're trying to minimize the monthly payment to maximize the forgiveness. However, if you're not eligible for forgiveness, that interest capitalization is going to make your balance higher and higher and higher. So we want to make sure that we just avoid missing those deadlines, and that's what Savvy helps you to do, and stay in the program until your repayment is done.
And it's worth thinking about. I think the idea is that you'd use Savvy to do the initial application. You'll know how it's done. You can do it yourself in following years. but the advantage to paying the fee annually is that you then get reminders about things like this deadline, and that may be in the long run more helpful. But up to you or your client to decide what to do.
Yep.
Good.
I would also mention, oh, sorry, Bruce. I was just going to say one more thing. For borrowers at any point in sort of their the cycle of their loans, if at any point during the year, maybe their income changes or their situation changes drastically or something happens, unemployment or whatever, they can reach back out to us and we'll be able to, based on that new information, adjust their income-driven payment accordingly to help them lower that and take advantage of the situation as it is. So what's great about these income-driven plans is that they're able to take a snapshot of that income situation at that point in time and lock it in for 12 months. And so we can always, if there is a decrease in income, especially before that recertification period comes up, we can resubmit that application to have it readjusted and lowered at any point during that year. And borrowers take advantage of this with Savvy because they know about it. Otherwise, they would think that they have to continue making those payments. So you always have the option if things change to lower it, and we help you do that.
Great. Well, this has been terrific. Thank you so much, Lindsay. What a great program. Glad that we're working together. We're going to do a couple quick things to close out the call. One is just a reminder that we're still doing the Pictures Still Worth 1,000 Words. These are terrific, and thank you so much for everybody that sent ones in. This one's from Repco in New York. Great to have it. Quick reminder about becoming a member if you aren't already. We still have the credit report discount available widely, and if you're caught up in your dues, we will now make the Savvy discount available as well. And obviously, the real thing to join is to support our work in fighting in Congress to get both more funding for housing counseling and to have a positive impact on affordable housing in this country, plus all the educational things we're doing. It's been a great year. Actually, we're now 7.5 years old, so we've done a lot of good things. We're glad that you're doing great work. We want to kind of do this all together. We really appreciate the support we've seen from our community, and being a member is part of all that. And really pleased how strongly groups have joined and supported over the years. And if you haven't already, please join us for that as well. And if you're new to our calls and want to get them, just go to our website, www.hsgcenter.org, and click the mailing list and get on the list that way. And we'll keep you informed. And with that quick note, our next call will be early March. We're thinking about doing this around legislative initiatives and advocacy and recruiting some experts for that. Melody will do the call. It should be a pretty substantial one. And with that good note, we'll stay in touch, and we'll. And one other quick thing is I'll try to get this the link out today to the member organizations. I just have a tight schedule. If I don't, it'll have to be on Monday. But keep an eye out for that if you're a member and caught up on your dues. Okay, thanks.